Have you already invested in dividend stocks? Do you want to know the best dividend stocks this year, 2023? Investments are valuable these days and are one of the wisest things you can do with your money. Even young professionals and newbies in business are encouraged to do so. If you are still considering investing in dividend stocks, this video is best for you. We will give you ideas of where it is best to invest this year, 2023, according to Nate O'Brien, a young American investor, business owner, and internet personality. His personal finance and lifestyle YouTube channel, which has more than 1 million subscribers and over 50 million views. It is also good to hear from entrepreneurs like him to encourage the young generation. So, let's start and talk about first what a dividend stock is. A dividend is a payment made by a corporation to its shareholders that the board of directors decides. Dividend payments are frequently made quarterly and might take the form of cash payments or stock reinvestments. The dividend yield, which is the dividend per share, is stated as a percentage of the share price of a corporation. For example, 2.5%. Suppose a common shareholder of a dividend-paying company owns the shares on the ex-dividend date or earlier. In that case, they are eligible to receive a payment. These are the 9 best dividend stock this year, according to Nate O'Brien. Number 1. Home Depot stock.
But then when you actually look at their fundamentals and you look at how much cash Home Depot is pulling in and the amount of cash that they're just flowing every single quarter, it does feel pretty good.
Home Depot is here to stay. Homeowners are less inclined to spend much money on renovation and improvement projects in a slow economy. Still, Home Depot is generally a recession-resistant company. Houses experience deterioration. Given the permanent value of the real estate, homeowners will invest in any economy to maintain the structural integrity of their homes and the functionality of their systems and appliances. The business recently increased its quarterly dividend by 10% to $2.09, reiterating its dedication to giving investors their money back. The company is also quite effective. In 2023, management aims for an operating margin of 14.5% and a 45% return on invested capital. Investors who purchase the drop might need to exercise patience depending on what happens with interest rates. Still, purchasing shares of Home Depot today is likely to be profitable in the long run. Number 2. Norfolk Southern Corporation.
And this is why I entered into it. Now, they have a PE of about 15. Their dividend's paying about 2.5%. I think it's like 2.44% as a total dividend yield. So I think it's a good position to be in right now.
Norfolk Southern Corporation is a holding company. The business transports completed goods, intermediate items, and raw materials by rail. The business provides access to and from the rest of the United States via interchange with rail operators. If you purchase Norfolk Southern right now, you would be doing so at a price roughly 12.67% above my intrinsic value, making it appear fairly valued. Even if you think the stock is worth $207.52, there isn't much room for the share's price to rise above where it is presently trading. Will there ever be another chance to purchase stocks at a discount? As the share price of Norfolk Southern is fairly erratic, it may drop or rise in the future, providing us with another chance to buy. Number 3. Air Products and Chemicals.
The number one thing I always look at with dividend stocks is their ability to pay out, right, and make sure that they can sustain that dividend. And Air Products has paid a dividend for as long as I can remember, my entire life, and because they've always been very profitable as a company.
Payment from Air Products and Chemicals has strong earnings coverage. High dividend yields are fantastic. A reputable history can be found at Air Products and Chemicals. The business has a long history of consistently paying dividends. The most recent full-year payout was $7, but the annual payment was $2.56 in 2013. This suggests that the corporation increased its dividends by around 11% per year over that time. The fact that payments have maintained a very great rising trend without halting gives us some confidence that subsequent payments will also be trustworthy. The dividend seems to be growing. The dividend income obtained by shareholders who have held shares in the company for a few years will please them. We were delighted by Air Products and Chemicals' impressive 5-year EPS growth of 16%. Nonetheless, the absence of cash flows causes us to be concerned, particularly concerning the dividend's future. Number 4, Barrick Gold.
But right now they're paying 10 cents per share as a dividend. You have to be careful with a company like this because they might end up cutting this. Like last quarter, it was 15 cents per share. Now it's 10 cents per share. So I'm getting 40 cents per share as a dividend, which I don't know the math on that, but
Aside from being a fantastic strategy to hedge against excessive inflation, Barrick Gold stock's dividend is also a treasure. Like any wise investor, Buffett believes that having the goose that produces a golden egg is preferable to simply having the egg itself. And to a value investor like him, that is precisely what Barrick Gold stock represents. It is insured without cost to you. No one is required to guard it for you. Also, it's a simple way to speculate on the price of gold while earning a meager dividend return of 0.96%. Because if the value of the materials Barrick is extracting from the ground increases, so do its profits and stock price. The actual precious metal is now widely recognized as a haven investment. Its usage as an inflation hedge is just one of the many reasons. You see, supply and demand play a big part in how much gold costs, and the supply is still quite consistent, despite the efforts of organizations like Barrick Gold. 5. Realty Income.
Realty Income. So Realty Income, this is a real estate investment trust. Look, they own so many different units in the United States, in Spain, in the UK. A lot of them are actually triple net leases, so they do a lot of corporate leases as well. So I think overall, it's pretty stable.
Realty Income offers excellent management that is very skilled at locating properties with good returns. The outstanding track record of success of the REIT amply demonstrates the power of Realty Income's net lease business model and the caliber of its management. Over the past 10 years, the trust's FFO per unit has increased annually at an average rate of 6.4%. Thanks to the purchase of high-return properties and dependable rent increases made possible by triple net leases year after year, it has maintained such a stable growth record. Even better, there aren't many future indications of weariness. Instead, major new property purchases, such as the acquisition of VEREIT, have helped Realty Income improve recently. The trust is therefore prepared to announce a 9% increase in FFO per unit for 2022, reaching a new record high of almost $3.90. Number 6. Altria Company.
The reason why I like this company as an investment is because the dividend yield is very attractive and I believe to be pretty sustainable and stable as a dividend. So it's yielding about 8%.
Smoking is harmful to your health, as we all know, but the repercussions of vaping are far more debatable, with opinions from medical specialists all over the world. Regardless of your opinion of tobacco, one name dominates the sector. Is Altria a reliable dividend stock, though? One of the biggest tobacco corporations in the United States and the world. Altria has a number of subsidiaries, including Philip Morris USA, Nat Sherman, John Middleton Company, and others. Even substantial minority shares in AB InBev and Juul are held by it. Although Altria brands have regulatory exposure, they are nonetheless available on some retail shelves. The company's cigarettes and other tobacco goods are still sold at Walmart. Altria has the shop space to handle whatever happens next, despite estimates that cigarette sales will continue to fall, particularly as more senior smokers pass away from smoking-related causes. Number 7. JP Chase & Company.
JP Morgan. So I love JP Morgan. I think it is the best bank out of all of the different financial institutions in the world.
American bank and global financial holding JP Morgan Chase & Company. Its precursor was established more than 200 years ago, making it one of the oldest financial institutions. Its total assets reach over $2.5 trillion, making it the largest. JP Morgan is a very reputable bank whose stock price has significantly declined since the year's beginning. While it has some near-term obstacles due to a weakening economy, it is well positioned to tackle these problems. With aggressive capital returns, management has been shareholder-friendly, and it could emerge from the present cycle in a strong position. As a result, I consider JPM to have it everything, including a high-quality business, a low value, and a tempting dividend yield. Number 8. PepsiCo.
We've seen that recently. They made those earnings announcements. They're paying a pretty decent dividend, $1.15 per quarter, which comes out to, $4.60 per year, which is a 2.61% dividend yield on this stock. And just look at the long-term results of PepsiCo. It's pretty stable.
Investors recently worried about a long-term decline in carbonated beverage sales, but it turned out that this was not a secular trend after all. Grandview Research does predict that through 2028, the global market for carbonated beverages will increase at a compound annual growth rate of 4.7%. PepsiCo's company is still fundamentally sound, which should keep its run of dividend increases going. In February 2023, PepsiCo announced its 51st consecutive year of dividend growth, increasing the annualized dividend by 10% to $5.06 per share. Number 9. Vanguard High Dividend Yield ETF.
Right now, I think it's paying out about 3% annually in dividends. I'm not quite sure. I need to look that up. But it also has a very low expense ratio, which I find to be very great for an ETF. Always be careful on ETFs if you're paying high expense ratios. Really anything over like 0.5% is kind of ridiculous. That's why I like the Vanguard funds.
Beginner and experienced investors who want access to a variety of low-cost, extensive mutual fund and ETF choices, all packed inside an easy-to-use brokerage platform. Consider Vanguard. Vanguard was one of the few holdouts in the zero-commission revolution, but the corporation no longer charges commissions for online trades of stocks and ETFs. The fee ratios for Vanguard's proprietary mutual funds and ETFs are among the lowest. Vanguard offers thousands of other mutual funds on a no-transaction fee, NTF basis, in addition to the great family of mutual funds it offers with no transaction fees. The best thing that we can do with our income is to invest, especially while we are young. We hope you enjoyed and learned a lot from today's topic. Be informed and be financially wise. What do you think about this topic? Do you agree with me too? Share your thoughts in the comment section below. Don't forget to like, share, and subscribe. I'll see you in the next video.